Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, Happy New Year.
Happy New Year, brand new year, same story, ETFs.
I am feeling incredibly bullish about the year ahead, so let's go to the biggest stories right now in the nearly $15 trillion global ETF industry. After that record 2024, we look ahead to the anticipated ETF trends and rising institutional interest.
Plenty of momentum driving crypto into 2025 with the race for the new hot fund now in full swing to lure investors.
And we also kick off the new year with a crossover. We'll speak to Joel Shulman of EntrepreneurShares on the first ETF, in his words, to hold both public and private companies. But as always, before we get there, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Scarlett, yes, new year, but same leaderboard virtually. At least the number one top dog ETF so far this year is VU again. After just crushing the record last year with 115 billion, it's got 1.6 billion. Extrapolate that for another 50 weeks, we're looking at another 116 billion. So we'll see if that changes, but pretty good sign if you've got that Vanguard bid coming in relentlessly. That's the growth fund right here. And small caps. Can it finally maybe be the year of small caps? People are going to keep trying. I'll tell you, I can guarantee that. There's some government bond ETFs, and nothing really too interesting here. Very mild leaderboard, more of the same. Let's look at the outflows, and you will see SPY at the top. This is probably some tax loss harvesting money, so I don't think this is really sentiment-based, especially given the market performance has been okay so far. IVV and SPY, so I think a lot of money in the first couple weeks can be weird because of tax loss harvesting. And there's some money out of DIA and the Qs, maybe a touch risk off, but nothing to write home about. Let's look at last year. We've covered all the asset classes. Let's look at the issuers. Who won the horse race, right? We always like to see who is doing it. And for a fifth straight year, Vanguard is the top winner with 304 billion in flows in the U.S., although BlackRock won the global race. BlackRock number two at 282. 282 is big. Look how much of a jump that is over last year. 106 last year, 282 this year. So BlackRock had a really big year. The Bitcoin ETFs helped them a lot. The two of them, though, the big two, 55% of all flows. It's almost not fair. They really do dominate this industry. So you can see the BlackRock, the drop off here to Invesco. Now, 85 billion for Invesco is massive. That's their biggest year. Most of these companies had record years. Extreme record years would be Invesco, Fidelity, and Cap Group. They really had good years. So again, same story, Katie, the big two, but there's plenty of flows to go around.
All right, Eric, thank you. Let's keep this conversation going with Amrita Nandakumar. She is the president of Vident Asset Management, joining us on set. Happy New Year to you.
Happy New Year. Thanks for having me.
So let's start with the horse race, of course, as Eric just walked us through. And it's been that setup for, as Eric said, 5 years running now. Vanguard edging out BlackRock. This year, or this past year, is a little bit interesting, though, because you think about IBIT and the success that BlackRock had with their Bitcoin fund, $50 billion plus coming into IBIT. It still wasn't enough to beat out Vanguard.
There's a reason that Vanguard has been successful for so long. They've been consistent with their messaging all along. They believe in core asset classes, investing for the long term, keeping expenses low, and that message is clearly continuing to resonate with both financial advisors and retail investors. So in my mind, as long as investors stay confident in U.S. large caps, I continue to see flows pouring into VOO. I mean, it was the largest asset gatherer last year with 123 billion in inflows. If you combine that with the iShares counterpart, the S&P counterpart, that's almost 200 billion in net new flows last year. And so in my mind, I continue to see that momentum into 2025.
You know, what surprised me with that leaderboard that Eric showed was Invesco and its leapfrogging into third place, displacing State Street, which was a real surprise. What's going on in Invesco that has them gaining so much momentum and perhaps building on it in 2025?
Invesco, in my mind, has always been quite innovative. They've been fast movers, and they're not afraid to compete on price. With State Street, I'm not counting them out, though. With Anna Paglia heading that up, and they've been doing some interesting things as well. Of course, talking about the SSGA Apollo filing, but I think for 2024, Invesco, they saw where the market was going, and they got there before the rest of the market did.
Invesco, it's interesting, they have QQQ and then QQQM, which is their low cost. That was 26 and 14 billion each. So the Q is obviously a big winner for them, and RSP, the equal weighted. Let's look at Janus. Janus also destroyed their record. They actually made it into the top 10. Janus, right? You forget about them, but JAA, J-A-A-A, which is the CLO ETF. JAAA.
I like
for
that
yeah.
moniker.
JAA.
Yeah.
Like Ja Morant, but that's an NBA reference. Anyway, so the ETF took in over $10 billion. It was the third or fourth biggest inflow for any bond ETF. And this is a pretty niche area, CLOs.
Right.
I thought this was it really showed that even if you're legacy, even if you're known for this one thing, you can come in and find white space.
I think financial advisors appreciate when managers really stay true to their core competencies. Janice, as you said, being known what it's been known for all along. And CLOs, I think, took up so much airtime this year because I think the market is increasingly getting excited about the notion of exposure to private markets in the ETF wrapper. And to me, this is just a harbinger of things to come.
I mean, what Janice has done is just amazing because that's a category that they absolutely dominate. Even BlackRock has not been able to really unseat them. BlackRock also has a AAA CLO ETF. It's at like 600, 700 million. JAAA at almost 17 billion. So it's been amazing. But I won't ask you more about that. I want to go back to what you were saying about that State Street filing with Apollo for a private credit ETF. This is one of the hottest topics in ETF land. Do you think that 2025 is the year potentially that we actually get one of these funds to launch?
I'm bullish. If you look at President Trump's nominee for the SEC, Paul Atkins, he's known for being supportive of reduced financial regulation in order to support innovation in the industry. So in my mind, if there was ever a time for that type of product to get approved, it would be now. Now, the ETF industry broadly is paying attention. I mean, Larry Fink said in an earnings call that in his mind, indexing private markets is the biggest opportunity for BlackRock potentially ever. And so a lot of filings have come out, and I feel like it's prompted some really meaningful dialogue about what it means to actually have exposure to private markets in the ETF wrapper. How would that be structured, and what would be the benefits and some of the risks of doing so?
When you index private markets, are you creating an allocation of its own, or do you compare it in any way to equities or fixed income or any of the existing asset classes?
Well, I look at the way that FAs are currently allocating to alternatives. Right now, 14% of advisors are allocating to alternatives through the ETF wrapper. And so I'm curious to see through what lens they will categorize these new ETFs.
Another big story and a possible huge new pipeline of flows will be if the SEC approves ETF share classes of mutual funds. Vanguard obviously already did it. It's worked for them, obviously. Now that patent's gone. 42 mutual fund companies are applying for this. My guess is they get it done. I mean, you don't have that much power. The ICI wants it. What will this mean? Will it mean that everybody in a mutual fund can just, boom, go to the ETF share class and just say bye to the mutual fund? Is this going to be just a massive, like, couple $1 trillion in 1 year type deal? Or do you think it's going to be maybe less overwhelming in terms of how much it would affect where we're at?
I see a couple of use cases for these multi-share class ETFs. On one hand, I can see issuers trying to perhaps revamp an asset class or revamp a fund that they think might benefit from being publicly listed and tradable all day long. I mean, Fidelity has just announced that it's planning to convert an index bond fund into an ETF. And I believe that's the first time an issuer has actually announced converting a mutual fund that is already indexed. I also see potential success with 401ks. I think for ETF issuers, the 401k is sort of one of the last frontiers. And I think the multi-share class is, in a way, a bet that they can finally break into these retirement plans.
That's really interesting because
I call it the Alamo.
the Alamo?
Yeah, 401ks are the Alamo of mutual funds.
I
You
like
that?
the final frontier, you know.
Okay, all right, well.
But it's
Same imagery, though, when it comes down to it, right?
Well, we're saying the same thing, but it's interesting that you bring up 401ks because speaking of State Street, Anapaglia, and of course all the innovative things they're doing, they're trying to basically pioneer that route to launch mutual fund share classes of their ETFs to get into 401ks. Do you think that we'll ever actually truly just see ETFs on their own in 401ks, though?
I think to some extent, to the extent that plan sponsors want to be seen as innovative and trying new things. Now, I go back and forth in some ways because I don't know that plan sponsors are really clamoring for ETFs broadly. Clearly, 8,000 mutual funds out there. There's no shortage of options, low cost, diversified, both passive and active options. But I think to the extent that ETF issuers can market themselves well and maybe come up with really interesting exposures that perhaps mutual funds have not been able to capture, we could see some of those being standalone options in a 401k.
So we talked about the final frontier. What about UConn, University of Connecticut, broadening its endowment to include ETFs at the expense of hedge funds? Is that an example of what we're going to see more of in the coming year? What are you hearing?
I believe so. I think UConn deciding to divest all of its hedge funds in favor of ETFs is really a validation of the ETF wrapper. They specifically cited liquidity and lower expenses. And so given what a focus alternative ETFs were in 2024, for example, UConn decided to put all of their money into buffered ETFs. I continue to see that dialogue into 2025.
All right, sadly, we got to leave it there. Great to get some time with you to kick off the new year, a new year of ETF IQ. Amrita, Nandakumar of Vident Asset Management. Now, coming up after a huge year, the race for the next big crypto fund is underway. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with WisdomTree. You're actually going to be looking at a chart of shares here. I thought it was interesting. You take a look at the sell-side community. North Coast last week downgrading WisdomTree because of the $1 trillion that flowed into U.S. ETFs last year. WisdomTree funds attracted just $1.6 billion of that. That earned a downgrade, but it's unintuitive. You take a look at the shares' performance. They're up 129% over the past 5 years. That is outperforming BlackRock. That's outperforming the S&P 500. So go figure. Let's talk about gold, though, because gold, it had a great year in 2024, the metal itself. But you take a look at what ETF investors are doing about it, and they're selling their gold funds for a fourth straight year. So no love for, of course, physical Bitcoin. But then you take a look at Bitcoin itself, also known as digital gold. And it's interesting. IBIT was a success story by any measure, attracting over $50 billion in its first year of life. By some measures, that's actually the most successful launch on record. It finally saw a record outflow, though, to the tune of more than $300 million, which is a record, of course. But Scarlett, it's amazing that a fund of this size, $300 million, is not that much.
It's not that much, given how much it's raked in over the past couple of months. Let's talk more in depth about this issue and the race to launch the next hot crypto fund with Bloomberg's Vildana Hajric. Vildana, you took a look at the filings, and it's clear that crypto, everything is the flavor of 2025. Give us a sense of what kind of filings are out there and how they've really built on the crypto craze.
So I think I went through all of them, if not almost all of them. And what struck me was just how many were centered on crypto or on Bitcoin. So we had one filing where it's looking to denominate the S&P 500, the NASDAQ 100, and gold in Bitcoin. We have another that's looking to launch a Solana fund, which there are other filings for Solana funds, but also inverse and leverage Solana. We have some that are centered around convertible bonds issued by companies that then use the proceeds to buy Bitcoin, which we know MicroStrategy is doing, and some others are also following in MicroStrategy's footsteps. So a variety of things all around, the crypto space, crypto assets, because I think there is a lot of hope that with the new Trump administration, there'll be looser regulatory environment around crypto and potentially prices, going bonkers and going higher once again, just like they did last year.
Yeah, we got the 100% hedged Bitcoin ETF coming out in a couple weeks from Calamos. There's also just an onslaught of filings to track other coins, Solana, XRP, HBAR. What's your take on that? Do you think we're going to see those get launched as well?
I'm not in the business of making predictions.
That's your job.
That's your job, yeah.
All right, well,
I was going to ask you the same question.
I have thought of asking myself questions, but I want to know your answer.
For an interesting
seriously.
show.
I think among issuers, the sense is that it's just much more likely to happen than it would have been over the past 4 years, because really the idea, as we know, is that regulations would just be a lot looser. We know that the incoming Trump administration has embraced crypto in a variety of ways. We even had President Trump talking at the flagship crypto conference last year, talking about Bitcoin and what his administration would do for cryptocurrencies and for the industry. So I think from the issuer perspective, this is why we're seeing this. It's possible that some are just throwing some stuff out there and seeing what sticks, but we could also end 2025 with a lot of these having launched.
If you want to ask yourself questions, you could probably just look at a different camera for the answer. And I think that would actually work kind of nicely, but we'll have to try it out.
I'll pitch that show.
Yeah, we'll practice in the commercial. Vildana, we have to leave it there. Great to see you. That, of course, is Bloomberg's Vildana Hajric.
All right, still ahead on ETF IQ. We drill down into the first ETF that combines public stocks with private equity with Joel Shulman of EntrepreneurShares next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu here with Katie Greifeld.
It's time for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, Scarlett, today we have XOVR, which is the Ershares private public crossover ETF. We talked about private earlier. Private credit is what we're expecting this year, the Apollo State Street. But what about private equity? Well, that's already kind of baby stepped into the ETF world. This stuff is going to happen in increments. This might be a pioneer, if you will, because it holds 30-ish stocks that are entrepreneurial, and one of them happens to be SpaceX at a 10% weighting. More on that in a minute. You can see here it came out in 17, so it's kind of old. 75 basis points is the expense ratio. Let's look at the holdings here, and we're going to see that SpaceX is now the biggest holding of this, right? So you can see other companies which have tickers, they're going to be public, right? NVIDIA, Google, you recognize this. So it's like Q's Arkish, but with SpaceX here. And that is interesting, again, because ETFs traditionally don't hold private equity, right? We'll go over how this is possible in a minute. Let's look at the performance of this versus, I put ARK in here and ARK VX, which is their venture capital interval fund, and the Qs. And you can see over the past 2 years or so, it has outperformed all of these by a good margin. So that's why it's got $200 million. And a lot of that's come in recently, Katie. So performance will get you looks, and that's the case here.
All right, Eric, thank you. And joining us now to talk about this ETF, I'm pleased to say we have Joel Shulman. He is founder, CEO, and CIO of EntrepreneurShares, joining us on set. And let's just start with how this works. So how do you actually hold SpaceX? Because as Eric walked through, I mean, the conventional wisdom is that an ETF holds public companies.
Right, that's absolutely true. In August 29th of last year, we actually relaunched. So we previously were an actively traded fund. That's why the performance, looks the way it does from 2017 on. So in August, we relaunched, rebranded to have our index. So we have something called the Entrepreneur 30 Total Return Index, which has a very long, compelling history of 30 stocks. And on August 30th, or August 29th, we decided to have this Entrepreneur 30 Index to represent the 85+%, because as a 40 Act fund, you have to be limited to only 15% in privates. The privates could be in anything. You can have, you can have art, you can have private equity, you can have anything for the 15%. We decided, because of the growth in private equity that was precluding retail investors from getting in, we were trying to democratize the access to private equity, and we decided we're going to start doing that. So we bought into we bought into positions, primarily SpaceX, and that's our dominant position right now.
That's your dominant position right now, but how often do you anticipate adding or making changes, trimming your holdings? What's the criteria for you?
Well, so we monitor closely, just like we do with this index. So if you look at the Entrepreneur 30 Total Return Index, we rebalance and reconstitute quarterly. So this Friday, we're going to rebalance and reconstitute. Now, SpaceX is a long-term hold for us. We're not going to change that at all. In fact, we may add to it. All right. So that's right now. If somebody wants this position, it's the easiest way they can get into it. So the 30 public stocks, which is the index, that rebalances, reconstitutes quarterly. The privates we're going to be adding as we see opportunistic.
So not limited to quarterly shifts.
No. The privates will come in opportunistically, as we did. So when we first bought SpaceX. We did that on December 2nd. So the fund relaunched, rebranded August 29th, but we were trying to be careful with our first position. We did that on 12/2, on December 2nd. And it was a fortuitous purchase because the stock company immediately announced a tender offer, so it went up 37%. And we actually bought more. We added to that position. And now, as Eric mentioned, there's been a large flow of AUM the last month, primarily the last month. And so we're probably going to rebalance and add more to it.
How does it work with market makers, right? Because if you have an illiquid position, I would expect a little more premium discount, but it looks pretty tight, the arbitrage band. How does a market maker hedge the basket with one of the stocks being illiquid? Do they use a proxy? How's that work?
Well, so it's a custom basket, and the 30 stocks from the index are extremely liquid, right? And so they have, you mentioned, Google and so forth. Actually, AppLovin is our second biggest position. We've been in it for about 2 years, and so that's really helped us. But it drifts down into things, for example, Today Hood and others are in there. But they're all very liquid stocks. So they know they can price that within a couple basis points, a couple of cents. And then the privates really don't trade that often. I mean, we're not changing the price that often. There are ways we can look at it. We're monitoring secondary activity. When we go back to buy, that's an indication of when we may want to reprice it. But otherwise, it's not changing that often.
So this is a baby step into privates.
Right.
What's the next baby step? How far can we take this?
Well, I mean, potentially, right? So right now, we've got our hands full, and we're very excited to keep private equity there for a while. So we're going to keep adding things like SpaceX and maybe XAI and things like this. But we have someone who's approaching us for, by the way, there's a lot of opportunity globally where we have a global fund. We have a global mutual fund that is very small AUM. It's only 43 million. We have a position SpaceX there. Nobody's buying it yet. We're going to make that an ETF, so that's going to be a global ETF. So when things like Klarna come out to market, an international stock, and they want to go public, it's going to be perfect for a global fund. And then down the road, there are other things that we're looking at. Right. A lot of excitement here in the alternative basket, because what we're finding from the portfolio managers we're talking to, the ones who are running the big money, they say people get excited about alternatives. And right now, the excitement is really high with SpaceX because of Starlink and other things.
All right, Joel, we got to leave it there. Keep in touch, though. It sounds fascinating. That is Joel Shulman of EntrepreneurShares. You can read about this drill down, plus the latest in the ETF industry, if you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. This is Bloomberg.